Hi, welcome to FinFlow Podcast. You're tuning into the deep dive, and today, well, we're plunging into a topic that seems straightforward maybe on the surface, but actually holds some really profound, often counterintuitive insights for pretty much every single one of us. We're talking about the psychology of money.
Yeah, it's a subject that really fundamentally challenges the traditional way we think about finance. When most people hear money, their minds jump straight to, spreadsheets, complex equations, cold, hard numbers.
Right. Calculations, logic.
Exactly. Precise calculations, perfectly logical decisions. But as we're going to explore today, that's really only half the picture, and arguably maybe not even the most important half.
That's precisely why this deep dive feels so necessary. Our mission today is to kind of move beyond just the arithmetic. We want to delve into those surprising, very human elements that truly drive our financial decisions. I mean, think about it. Our biggest money choices, they don't happen in some sterile office with an algorithm. They happen around dinner tables,
Yeah.
right? And they're often fueled by really personal emotions, fear, pride, ego, hope, maybe even regret sometimes.
Absolutely. And they're shaped so deeply by our personal histories, our upbringing, that subtle, often subconscious dance between the cold logic of a balance sheet and just the messy, unpredictable reality of being human.
Yeah, the messy part is key.
It is. Morgan Housel, whose brilliant work, The Psychology of Money, inspired a lot of this discussion, puts it so well. He says financial success isn't primarily about what you know. It's not about your technical skills in the market or having some advanced economics degree.
Okay.
It is almost entirely about how you behave. So this deep dive, we're exploring that strange, compelling, sometimes illogical human side of money, and hopefully uncovering insights that could really reshape how you think about your own financial journey and maybe even how you see other people's decisions.
That's a really powerful distinction and probably counterintuitive for a lot of people, right? That behavior trumps knowledge. So if behavior is the key, where do we even start to unpack why people act the way they do with their money?
Well, a great starting point is this idea that we all have something you could call a financial DNA.
Financial DNA. Okay, I like that.
Yeah, it's like this invisible, unique blueprint for how we think and feel about money. And it's deeply imprinted, usually from our formative years, our upbringing.
Right. So it's not something we consciously choose necessarily.
Not entirely. It's fascinating how diverse these blueprints are. Just think about the sheer variety of experiences people have. We come from different generations. Our parents had different incomes, different values about spending versus saving.
Different economic times too, I imagine.
Exactly. Different environments, different incentives, different opportunities available to us. All these factors mix together to forge these incredibly unique personal experiences and attitudes towards money.
And that explains why, say, one person sees a market dip and totally panics,
Right, wants to sell everything immediately. It feels like a catastrophe.
while someone else sees that exact same dip and thinks, wow, this is a huge opportunity.
Precisely. Their reactions aren't random. They're rooted deep down in their unique financial conditioning, their DNA.
And that generational impact you mentioned must be huge.
Yeah.
Like how different generations view the stock market.
Oh, absolutely. It's incredibly striking. Let's take someone born around, say, 1970. Their teens and early 20s, those really impressionable years happened during an amazing bull run, the S&P 500. It went up almost tenfold during that period.
Wow, tenfold.
Imagine watching that kind of growth just unfold right as you're forming your basic ideas about the world and how money works, that kind of experience. It tends to lead people from that generation to develop a generally positive view of the stock market. They see it as this powerful engine for creating wealth.
So they'd naturally be more inclined to invest, maybe take a bit more risk.
Generally, yes, much higher inclination to invest compared to, say, someone born just 20 years earlier in 1950.
Okay, so what was happening for the 1950 cohort?
Well, their teens and 20s were a completely different financial world. They basically watched the stock market go sideways, essentially nowhere, for years, decades even.
Ouch. That must leave a mark.
A big one. That stagnant period really shapes your perspective. It fosters a much more cautious view, maybe even a negative or skeptical outlook on investing in stocks. Their lived experience taught them a tough lesson, maybe about patience, or maybe they felt it was futile. While the later generation learned optimism, maybe even saw easy gains.
These aren't just slight differences in opinion then. They're deep psychological imprints.
Exactly, deep-seated.
It's incredible how those early experiences frame everything. So thinking about today, when we see maybe younger generations seeming less worried about inflation, is that just because they haven't lived through a really bad period of it?
That's a huge part of it, definitely. The lack of direct lived experience is a primary driver. But it's also about the broader economic stories, the narratives that were dominant when they were growing up.
Right.
If you were born in the 1960s, you likely remember, or your parents certainly did, the impact of significant inflation. Things like the oil shocks, the cost of living soaring.
Yeah, I've heard stories, gas lines, prices
Yeah.
jumping constantly.
That leaves a lasting, almost visceral impression. You become acutely aware of how inflation eats away at things. You probably hold a more negative view because you saw its power firsthand, how it eroded savings, purchasing power.
You might also just get used to prices always going up, demanding higher wages.
It becomes part of your expectation. But then contrast that with someone born, let's say, 1990.
Okay, different world.
Totally different. For most of their life, inflation has been relatively low, pretty stable, almost an afterthought for many.
They haven't had that direct, painful experience of prices spiraling or needing, a wheelbarrow of cash for groceries like in historical hyperinflation examples.
Exactly. So naturally, there's often far less concern, less immediate awareness about inflation and what it could potentially do to long-term savings or their future buying power. For them, it might feel more like an academic concept, something talked about in economics class, rather than a real present threat.
And these experiences, often working below the surface, they just shape everything. Attitudes, behaviors, decisions about investing, saving.
Profoundly, they become these unwritten rules we live by, even if those rules don't perfectly match the current economic reality anymore.
Okay, this whole financial DNA concept really helps make sense of why we act the way we do. But it raises a question, how do we square our own financial choices, which feel rational to us, with what others do that might seem, well, totally irrational?
That's where Housel introduces a really insightful principle. He calls it the no one is crazy principle.
No one is crazy. Okay, tell me more.
The core idea is fascinating. It suggests that every single financial decision someone makes, even the ones that look misinformed, illogical, or just plain bad to an outsider like you or me, makes perfect sense to the person making it in that specific moment.
Makes sense to them.
Yes, their choices aren't random. They align with their personal story, their unique mental model of how the world works, a model shaped by their life experiences, their financial DNA, and critically, the information they actually have access to at that time.
Wow, that requires a lot of empathy, doesn't it?
It really does. It's a powerful call for empathy.
That phrase, no one is crazy, if you really internalize that, it could change how you view everything financially. Instead of jumping to judgment when you see someone make what looks like a bad money move.
You start asking different questions.
Like what? What's the practical shift for listeners here?
The biggest shift is moving from judgment to curiosity. Instead of labeling someone crazy or irresponsible, you start asking, okay, given their experiences, their background, their financial DNA, the information they had, how would this decision make sense to them?
Okay.
It fosters huge empathy. And importantly, it also lets us be a bit more forgiving of our own past financial mistakes.
That's interesting.
Yeah, recognizing they were made from our unique viewpoint back then. And it also implies there isn't one single universally correct textbook way to manage money successfully. Your unique worldview, shaped by everything you've absorbed, is valid to you. It encourages self-awareness about our own biases and more openness to understanding why others do what they do.
So our individual financial DNA means everyone's rational in their own context. It really highlights how unique each person's financial path is. But what about principles that seem universal? Like when we look at someone universally hailed as a financial genius, like Warren Buffett, we usually just point to his incredible brain, right? His skill. But Housel suggests his real superpower might be something, well, something more accessible.
It's actually mind-blowing when you dig into the numbers behind Buffett's wealth. Get this. A staggering $81.5 billion of his roughly $84.5 billion net worth was earned after he hit his mid-60s.
Wait, say that again, after his mid-60s?
Yep. Almost 97% of his immense fortune piled up in his later years.
That's insane. So it wasn't just about being brilliant early on.
Housel's insight is that Buffett's fortune isn't just because he's an incredibly good investor, which, don't get me wrong, he absolutely is one of the best ever. But his main advantage, his real superpower, comes from the fact that he's been a good investor since he was literally a kid. He started seriously investing at age 10.
10 years old, that's the key, the time.
It points to a power that's way more democratic than just innate genius. It points to time and compounding.
Right, compounding. It's a word we hear all the time in finance, but do people really grasp how powerful it is?
Yeah.
I mean, intellectually maybe, but intuitively?
That's the thing, it's deeply counterintuitive for most of us. Compounding, simply put, is earning returns not just on your initial money, but also on the returns that money has already generated.
Interest on the interest.
Exactly, like a snowball rolling downhill. It
That-
picks up more snow, gets bigger, rolls faster. It accelerates.
Yeah.
I'll use a really simple example. Say you invest $1,000 at, let's call it, 8% annual interest. Pretty decent.
Okay.
Year one, you earn $80. Your total is now $1,080. Simple enough. But year two, this is where the magic kicks in. You don't just earn 8% on the original $1,000. You earn 8% on the full $1,080.
So a bit more than $80 the second year.
Right. 8% of $1,080 is $86.40. So your new total is $11,166.40. You've earned money on your initial investment and on the interest you already earned.
So it's not just adding $80 each year, it's multiplying. It's exponential growth.
Precisely. The power is in that exponential accelerating growth. Your money starts working for itself, generating more and more returns on an ever-growing base. And over the long haul, the results can be, well, truly extreme. They kind of defy common sense because our brains are naturally wired for linear thinking, like 1 + 1, 2.
Not exponential, like 2 to the power of 10, which gets huge fast.
Exactly. We struggle to really internalize that exponential curve, which is why people so often underestimate compounding's impact.
And that connects back to Buffett, that longevity versus just skill. He started at 10, that habit, that early start.
By age 30, he already had a net worth of $1 million, which was a lot more money back then, of course. But that early foundation, that incredibly long runway, allowed compounding to just work its magic over decades and decades. It gave him an almost unbeatable head start.
So how much difference did that early start really make?
Hassel does this great alternate reality thought experiment. It's really eye-opening. Imagine if Warren Buffett had acted like, well, a typical young guy in his 20s, maybe spent his early earnings on travel, nice cars, just enjoying life.
Okay, relatable for many.
And let's say he only got serious about investing at age 30, starting with a decent chunk, say $25,000. And then, like many people, he decides to retire at 60. Now, here's the key. Even if he still managed to generate his incredible average annual returns of 22%, which is phenomenal still, almost unheard of.
Even with that amazing skill, what would his net worth be today?
Around $11.9 million.
$11.9 million. Okay, still a fantastic sum of money, obviously, but compared to his actual billions.
Exactly. It's 99.9% less than his actual $84.5 billion fortune.
Wow, 99.9% less.
It just powerfully demonstrates that Buffett's true secret weapon, alongside his undeniable skill, is time. The sheer power of compounding over an exceptionally long period. His success is largely down to that consistent base he built early on and his incredible longevity in the investing game. It's not just about how good you are, it's about how long you stay in.
That makes you think. If time is so critical, what about other brilliant investors, people who maybe started later but got even higher returns, like Jim Simons from Renaissance Technologies? His hedge fund has reportedly compounded money at something like 66% annually since 1988.
Yeah, an absolutely staggering number, far higher than Buffett's average 22%.
Okay, so 66% versus 22%? Yet Simon's net worth is around $21 billion, which is, what, 75% less than Buffett's $84.5 billion. How does that make sense? Higher returns should mean more money right now.
It's the exact same principle, the immense power of time, but illustrated even more dramatically. Housel points out that Simons, despite his genius, didn't really hit his stride with his quantitative investing approach until he was around 50 years old.
50. So much later than Buffett's age 10 start.
Much later. It meant he had less than half the number of years for that incredible 66% return to compound compared to Buffett's decades-long journey. Housel even ran a hypothetical calculation. It's almost absurd. If Simons, with his 66% annual return, had been investing for the same 70-plus year time frame as Buffett,
Okay, I'm bracing myself. What's the number?
his net worth would theoretically be $63,900,981,780,748,160,000.
63. Quintillion. Is that even a real number? It sounds like something from science fiction.
It basically is. It's so large, it's meaningless on a human scale. And that's
Yeah.
precisely the point. It just hammers home the core lesson. Never, ever underestimate the power of compounding. No matter how counterintuitive the results seem, time is the supreme multiplier.
So consistency and longevity can actually beat extraordinary skill if the time frame is short enough.
Often, yes. For anyone listening, the actionable insight is pretty clear, isn't it? The most powerful financial tool you possess might not be some complex strategy, but simply time in the market. Start early if you can, stay consistent, and just let time do its heavy lifting.
That's a fantastic point and a great segue, because if time and consistency are so powerful, why are we as humans so often drawn to the opposite? The drama, the negativity, the immediate crisis. Let's shift gears slightly to another part of our financial psychology, our relationship with pessimism.
Ah, yes, the pessimism bias.
Optimism basically is believing things will generally turn out okay over time, even with setbacks. But with money,
Yeah.
there seems to be this deep-seated pull towards pessimism. We just cling to it. Why? Especially when, objectively, many things have gotten better over the long run.
It's a really important question, and the answer lies deep in our evolutionary wiring, how our brains process threats versus rewards. Our brains evolved for survival, right? So they're highly sensitive to immediate dangers, to threats.
Like tiger of the bushes.
Exactly. Negative things often happen suddenly, dramatically. A stock market crash, a natural disaster. They grab our attention because they represent potential danger now. Good things, on the other hand, like gradual economic growth, medical breakthroughs, the slow accumulation of wealth through compounding, they tend to unfold slowly, incrementally.
Almost invisibly sometimes.
Yeah, they lack that immediate visceral punch. And because money is so tied to our security and survival, negative financial news triggers that primal alarm system much more effectively than slow, steady progress ever could.
Which explains why bad news dominates the headlines, right? It gets the clicks, the views.
Absolutely. Think about it practically. A 40% drop in the stock market over 6 months, that's huge news. Front page, lead story, government might get involved. It feels like a crisis.
You feel it in your gut.
Totally. But 140% gains spread out over 6 years, that's mathematically much better, obviously, but it often goes largely unnoticed. It's just quiet, incremental improvement. It doesn't create that same urgency or fear.
It's not dramatic enough.
Not dramatic enough. Or think about medical progress. Housel mentions something like 500,000 American lives saved every year due to medical advancements over the last 50 years.
That's incredible progress. Monumental.
It is a truly positive long-term trend, but because it's slow, consistent, spread across millions of individual stories, it gets far less attention than, say, one sudden plane crash or a single act of terrorism or a big hurricane.
Yeah, that makes sense.
Housel has a great line for it. There are many overnight tragedies, but few overnight miracles. Pessimism is alluring because it often feels more urgent, more immediate. It aligns with our brain's bias towards threat detection. It's an easy story to sell, and unfortunately, an easy one for us to buy into.
So how do we fight that natural pull towards financial pessimism? Especially since it can lead to bad decisions, like panic selling at the bottom or just sitting on the sidelines afraid to invest.
The key is to consciously cultivate what you might call practical optimism.
Practical optimism. Okay, what does that mean?
It's not about wearing rose-tinted glasses or ignoring real problems. It's about maintaining an informed belief that, over the long run, despite the inevitable setbacks and scary headlines, the odds of a positive outcome are fundamentally in our favor. Generally speaking, the world and markets are tilted towards progress, driven by human ingenuity, innovation, the constant search for better solutions.
So when the news is screaming about a market crash or economic doom,
Take a breath. Remember that things on a broad historical scale tend to improve over the long run. Try to zoom out from the immediate noise. Consider the historical arc. Understand that quiet, consistent progress is actually far more common than sudden catastrophic collapse, even though the collapses get all the attention.
that's a really helpful perspective, a necessary reminder, I think. Okay, let's move on to two elements that often get glossed over in stories of success, especially financial success: luck and risk. We love narratives about hard work, genius, brilliant decisions. But what about the role of chance?
Yeah, this is where Housel tells another really compelling story, starting with Bill Gates, a name everyone knows, synonymous with genius, vision, hard work.
Right. Built Microsoft from nothing.
Well, not exactly nothing. Consider this. Back in 1968, there were about 300 million high school-age kids globally.
A huge number.
Out of those 300 million, only about 300 attended a small private school in Seattle called Lakeside School.
300 out of 300 million. Tiny fraction.
Now, here's the crucial piece, the incredible stroke of luck. Lakeside happened to be the only high school in the entire world at that time that had leased a computer, a cutting-edge teletype Model 30, something even grad students at big universities often didn't have access to.
The only one.
in the world.
The only one. So think about the odds. In 1968, there was roughly a 1 in a million chance that you were a high school student with access to that kind of computing power. Bill Gates was one of them.
That gave him and his friend Paul Allen just an unbelievable head start, a competitive advantage almost no one else on Earth had. Exactly. Now, Gates was undeniably brilliant, incredibly driven, had a unique vision even as a teenager. No one disputes that. He was a force. But you simply cannot ignore the sheer, almost random luck that put him in that specific school at that specific time with that specific rare piece of technology.
Did Gates himself acknowledge this?
Oh, yeah. He said it himself years later. If there had been no Lakeside, there would have been no Microsoft. His incredible talent was paired with an extremely rare 1 in a million stroke of pure luck.
But the story has a flip side, doesn't it? There was a third member of that Lakeside computer group, Kent Evans.
Right, and by all accounts, Evans was just as bright, just as visionary, just as passionate about computers as Gates and Allen were. He absolutely could have been right there with them, a co-founder of Microsoft, changing the world.
So what happened?
This is where the close sibling of luck, what Housel calls risk, comes into play. Ken Evans tragically died in a mountaineering accident before he even graduated high school.
Well, wow.
And the odds of a high school student dying in a mountaineering accident, also incredibly small, roughly 1 in a million, another extremely rare event, but this time a devastatingly negative one. So just as an incredibly rare bit of luck helped propel Gates and Allen forward, an equally rare, terrible encounter with risk cut Ken Evans's potential short.
It's such a stark illustration. The outcomes we see, good and bad, are shaped by forces way beyond just our effort or talent.
Housel uses a great analogy here, a sailboat. Luck and risk. They're like the wind and the waves. They heavily influence the boat's course and speed.
And the sail.
But the sailor controls the rudder and the sails. That's your talent, your hard work, your decisions, your skill. You absolutely influence the journey, but the ultimate direction and speed, profoundly influenced by those external unpredictable factors, the wind and waves that you just can't fully control. They're just there.
So, understanding this, how should it change how we approach things, especially our finances?
It encourages humility, I think. Recognizing that success is this complex mix. Yes, talent and effort matter hugely, but there's also a significant, often invisible, dose of luck involved. It helps us approach our own decisions with more perspective, less self-blame when things go wrong due to factors outside our control, and maybe a bit more gratitude and less hubris when things go right, partly due to luck. It's a more realistic view of how the world actually works.
Okay, let's talk about happiness, because let's be honest, a lot of people chase wealth primarily because they think it's the key to happiness. It's kind of the default assumption in society, isn't it?
It really is, but Housel offers a different definition of happiness, one that I find much more compelling. He defines it as the ability to do what you want, when you want, with who you want, for as long as you want.
It's all about control. Control over your time.
Exactly. Control over your life. And what's really paradoxical about our modern world is that even though we are, on average, richer than ever before in history, with more stuff, more opportunities, many people find themselves working harder than ever, feeling more stressed, and actually surrendering more control over their time.
That's true. You gain financial resources, but you lose the freedom the money was supposed to buy in the first place.
Precisely. And study after study shows that having a strong sense of control over your life, your schedule, your choices, your daily rhythm is the single most reliable predictor of well-being. Feeling in control. It often ranks higher in predicting happiness than your salary, the size of your house, or even how prestigious your job title is. Control is the ultimate luxury.
So the biggest payoff from money isn't the stuff you can buy. It's the autonomy. Controlling your time is the highest dividend money pays. I like that phrase.
It's a crucial insight, and one that's easy to miss when you're just focused on accumulating more. Housel uses an analogy. Chasing money without valuing control over your time is like trying to fill a bucket that has a hole in it.
Okay.
No matter how much water you pour in, money you earn, it just keeps leaking out because you don't have the time or freedom to actually enjoy it or direct it purposefully. Similarly, accumulating vast sums won't bring lasting happiness if you don't have control over your time. If you can't actually use the money to live the life you want, you're just on a treadmill, accumulating but never arriving.
It forces you to think about wealth, not just in dollars, but in units of freedom, units of time.
Exactly. What does this money actually buy you in terms of life control? That's a much more powerful question.
All right, let's dive into a concept that's super important for understanding how success really happens, especially big success in finance or business. Tail events.
Yes, tail events. These are the outliers, the really rare occurrences that end up driving a disproportionate amount of the results.
And a great story to illustrate this is Heinz Berggruen, the art dealer who fled Nazi Germany.
His story is a perfect illustration. Berggruen became one of the most successful art dealers ever. But his secret wasn't necessarily having some infallible crystal ball for picking masterpieces. Instead, his strategy was more about breadth and time. He collected a massive amount of art over a very long period.
So quantity and patience.
Pretty much. Research suggests great investors, whether in art or stocks, often buy widely and hold for a long time. For someone like Berggruen, the vast majority of the pieces he bought, maybe 99% of them, turned out to be, just okay, not particularly valuable. Some might have been outright misses.
So he was wrong, or at least not spectacularly right most of the time.
Exactly. But it didn't matter, because a tiny fraction of his collection, the long tails, turned out to be works by Picasso, Klee, Matisse, pieces that became incredibly famous and valuable. Those few massive winners accounted for the overwhelming majority of his fortune when he eventually sold part of his collection for, I think, over 100 million euros.
Those are the tail events, the small number of occurrences that drive almost all the outcomes.
Precisely. The few huge wins that more than compensate for all the small losses are the things that just went sideways.
And this isn't just an art market thing, right? It applies elsewhere.
Oh, absolutely. It's fundamental to understanding many fields. Venture capital is a classic example. Most startups in a VC's portfolio, they'll fail, they'll lose money.
Right, high failure rate.
But the entire fund thrives because of maybe one or two outlier companies in that portfolio that generate 20x, 50x, even 100x returns. Those tail event successes pay for all the failures and then some. It's a power law game, not a normal distribution.
And big companies too, like Amazon?
Amazon is a fantastic example on a huge scale. Housel points out that in 2018, Amazon alone accounted for something like 6% of the S&P 500's total return that year. Just one company out of 500 driving that much of the index's performance.
Wow. But what inside Amazon drove that?
If you look deeper, Amazon's phenomenal growth over the years hasn't come from hundreds of equally successful products. It's been largely driven by two massive tail events. Amazon Prime, the subscription service,
Okay.
and Amazon Web Services, AWS, their cloud computing division.
Right, also gigantic.
Those two monumental successes have more than paid for all the other Amazon experiments that didn't work out. Remember the Fire Phone?
Oh yeah, the Fire Phone disaster.
All their attempts at online travel agencies and countless other ventures that just fizzled out.
Yeah.
That's why Jeff Bezos famously said after the Fire Phone flop something like, if you think that's a big failure, we're working on much bigger failures right now. Some are going to make the Fire Phone look like a tiny blip.
He understood the game. You have to take big swings, knowing most will miss, to hit those occasional home runs that change everything.
Exactly. He understood that making mistakes, having failures, is not just acceptable, it's necessary if the process occasionally spits out one of these transformative tail events that drive the whole enterprise. It's a mindset that embraces experimentation.
It's so counterintuitive. Because as consumers, or even as investors sometimes, we only see the successes. We don't see the mountain of failures behind them. Housel has that great analogy with the stand-up comedian, right?
Yeah, it's perfect. You watch a comedian's Netflix special and every joke lands, it's hilarious. You think, wow, this person is just naturally funny, a genius.
Right, flawless performance.
But what you're not seeing are the hundreds, maybe thousands of jokes they tried out in tiny clubs across the country for years. The awkward silences, the jokes that bombed completely, the constant trial and error.
The 99% that didn't make the cut.
Exactly. That Netflix special is the 1% highlight reel. It's the compendium of only the tail event jokes, the ones that consistently got huge laughs, the ones that really worked. 99% of the material tested along the way was probably just mediocre or worse. The comedian's success isn't built on being right every time, but on finding those few exceptional bits that connect massively.
So what are the implications of this tails drive everything idea for us in our investing or even just navigating life?
I think the biggest implication is realizing that it's completely normal, even expected, for many things to go wrong, to fail, or to just not work out. Most people ignore this. They overreact to every setback, seeing each failure as a sign that their whole strategy is flawed.
Instead of seeing it as just part of the process of finding the tails?
Precisely. Once you accept that tails drive the big outcomes in business, investing, finance, you become more resilient. Remember, even Buffett, out of hundreds of stocks he's picked, only about 10 generated the vast majority of his wealth. Even the best stock pickers are only right about half the time. Good leaders probably only make the right decision about half the time.
So being wrong or having things fail doesn't mean you won't ultimately succeed.
Not at all. The final outcome is often determined by a small number of disproportionately impactful events, both good and bad. Understanding this allows for a more forgiving, more realistic, and ultimately probably a more successful approach long term. You don't sweat the small failures as much.
Okay, that leads nicely into another common confusion Housel tackles. The difference between being rich and being wealthy. He calls it beyond bling. They sound similar, but he draws a crucial distinction.
Yeah, this is a really important one, especially in our culture that's so focused on outward appearances. Richness, as Housel defines it, is mostly about your current income and the visible things you buy with it. The fancy car, the designer watch, the huge house. It's what you see.
And it can often be funded by debt, right? Looking rich doesn't mean you are rich.
Exactly. Appearances can be incredibly deceiving. You can have a high income and spend it all, looking rich, but having very little actual wealth. Wealth, on the other hand, is different. Wealth is defined by the financial assets you haven't spent. It's the money working for you, quietly, often invisibly.
So wealth is hidden. It's the stocks, the bonds, the real estate investments that aren't necessarily flashy.
Precisely. You don't see wealth walking down the street. It's easy to assume that the person driving the Lamborghini is wealthy, but they might just be rich, high income, high spending, or even deep in debt. True wealth isn't the car or the diamonds, it's the unspent financial assets accumulating behind the scenes. It's the money you didn't spend.
Which requires a different kind of discipline, doesn't it?
A huge amount of self-control and restraint. Accumulating wealth is fundamentally about deferring gratification. It's the fancy dinner you didn't eat out, the luxury upgrade you declined, the impulse purchase you resisted. Those decisions, those acts of not spending, are what actually build wealth.
And because wealth is hidden, it's much harder to imitate than richness.
Much harder. Anyone can lease a fancy car to look rich. Building actual wealth takes time, discipline, and patience. It's less glamorous, perhaps. Society conditions us to think that having money means spending money, that spending is the proof of success.
But the real key to building wealth is the exact opposite.
It's saving and investing what you have, consistently. The core message is stark but true. The only way to be wealthy is to not spend the money you currently have. It's about building assets, not just showcasing consumption.
So don't judge a book by its cover, or rather don't judge wealth by the car someone drives.
Pretty much. True wealth is built quietly, through self-control, restraint, and letting your assets grow. It's an internal game, not an external show.
Okay, this ties into another concept Housel discusses, which he calls the real price. Let's use his mountain climbing analogy.
Right. Imagine you want to climb a beautiful mountain for that incredible view from the top.
Okay, sounds good.
Before you even start, you know there's uncertainty, right? It could be sunny, it could pour rain, it could get windy. There are risks involved. You could twist an ankle, get lost, maybe even worse.
Sure, it's part of climbing.
Exactly. You accept that there's no golden escalator that will just smoothly whisk you to the summit without any effort, danger, or discomfort. You understand intuitively that the uncertainty, the risk, the physical effort, that's simply the price you have to pay to get the reward of the view. It's inherent to the activity.
Makes sense. You pay the price for the experience.
But what's fascinating is that when it comes to investing, particularly in the stock market, a lot of people seem to think they can somehow avoid paying that price. They approach it looking for the reward without accepting the inherent risks and uncertainty. They want something for nothing.
How does that play out?
Housel uses another great analogy, buying a car. You basically have three options, right? Buy new, buy used, or steal one.
Okay.
Buying a new car costs more, a higher price, but generally gives you a greater reward. Reliability, features, maybe status.
Yeah.
Think of that like aiming for higher potential returns in the stock market, say 10–12% annually over the long term. You accept you're paying the market's price, which includes volatility.
And the used car.
Cheaper price, potentially less reward, maybe more bumps along the road, like a safer, lower return investment, maybe aiming for 4% a year, lower price, lower expected reward. And then there's stealing the car, trying to get the car for nothing without paying the price. Most people wouldn't steal a car because the consequences are clear and severe.
Right. Jail time, fines. Not worth it.
Exactly. Yet in the stock market, Housel argues, people constantly try to steal the car. They try to get the good long-term returns of the market without paying the price of experiencing the volatility and uncertainty along the way.
How do you try to steal it?
By trying to time the market perfectly,
Right.
selling just before a dip, buying back in just before a surge, trying to capture all the upside while neatly sidestepping all the downside. Effectively, trying to get the reward without enduring the emotional roller coaster that comes with market fluctuations. It's chasing a free lunch that rarely exists.
So if someone wants, say, that 11% average annual return the Dow Jones delivered between 1950 and 2019,
They have to understand that achieving that return involved living through numerous significant downturns, crashes, periods of fear and panic along the way. There were huge highs, yes, but also terrifying lows. For many investors, seeing their portfolio drop sharply feels incredibly painful, traumatic even. So they try to jump in and out to avoid that pain, essentially trying to avoid paying the market's price. They see the volatility not as a price, but as a fine, a punishment.
and the real price isn't just money lost temporarily, it's the emotional toll.
That's a huge part of it. The
Oh,
price you pay for good long-term market returns includes dealing with fear, uncertainty, doubt, regret, and watching paper losses happen from time to time. It's the emotional endurance required. Recognizing this inherent price, this admission fee, as Housel calls it, is absolutely crucial. It's not always obvious like the sticker price on a car, but it must be paid to earn the long-term rewards.
so you have to see the volatility as the fee you pay for the potential long-term growth.
Exactly. If you see that fee as a fine, something to be avoided at all costs, you'll never stick with it long enough to enjoy the potential rewards. You'll constantly be trying to dodge the fee, likely hurting your returns in the process. The key advice is understand what the price is. The volatility, the uncertainty, the emotional swings, accept it, and be willing to pay it for the potential long-term benefit.
That's a powerful mindset shift. Okay, one final concept that feels really important, especially in a world obsessed with more Millikan treadmill, and knowing when enough is enough.
Ah, yes, the hedonic treadmill or hedonic adaptation. This is a really fundamental psychological trap. It describes our built-in human tendency to quickly get used to good things and then immediately reset our expectations higher. We constantly move the goalpost.
So you think if I just get that promotion, then I'll be happy, or if I just make X amount of money.
Right. Or buy that specific house or get that particular car. You reach the goal, feel good for maybe a short while, but then your brain adapts. That becomes the new normal, and you're immediately looking towards the next goalpost, the next level up.
It's a perpetual chase that prevents lasting satisfaction. You're always striving, never arriving.
Precisely. You're locked into this cycle of never feeling like you truly have enough, because the definition of enough keeps shifting upwards as soon as you reach it.
And this isn't just about everyday dissatisfaction, is it? It can lead to really destructive behavior, even for people who seemingly have everything.
Absolutely. Think about figures like Bernie Madoff or Rajat Gupta, who Housel mentions. These were incredibly wealthy, powerful individuals. By any objective standard, they had everything. Billions, prestige, influence, yet they risked it all, resorting to massive fraud and crime. Why? Because they were trapped on that hedonic treadmill, driven by a need for more, for something just beyond reach. For them, as Housel puts it, all the money in the world would never have been enough.
Wow, they just couldn't step off the treadmill.
They couldn't. The relentless pursuit of more wealth, more status, more success, without ever defining a personal sense of enough, is like climbing a ladder that has no top rung. No matter how high you climb, there's always another level beckoning, another comparison to make. It becomes all-consuming.
And ultimately leads to a lack of real happiness or fulfillment because that destination of enough is never actually reached.
Exactly. Knowing when enough is enough isn't about killing ambition or stopping progress. It's about consciously defining satisfaction on your own terms. It's about recognizing that true contentment often comes from appreciating what you have, controlling your time, having strong relationships, things internal, rather than just endless external accumulation. It's about realizing the game is rigged against your happiness if you don't decide where your own finish line is.
Wow, what a fascinating journey through the psychology of money. We've covered so much ground today in this deep dive. It's just so clear that money isn't just about math, is it? It's so deeply tangled up with our human behavior, our personal histories, our weird evolutionary quirks, our individual psychologies. It's messy, it's personal, and it's endlessly interesting.
It really is. We talked about the almost unbelievable power of compounding and time, how that was really Buffett's secret weapon, even more than just skill sometimes.
Oh.
How consistency and just staying in the game for a long, long time can work wonders.
Yeah, and how that contrasts with our natural bias towards pessimism, right?
Ah.
Why bad news grabs us, while slow, steady progress often goes unnoticed.
Exactly. And we dug into those often overlooked elements of luck and risk. The story of Bill Gates and Ken Evans is just so powerful in showing how chance events can dramatically alter outcomes, reminding us to approach success and failure with a bit more humility.
And the idea that true happiness often comes from controlling your time, that being the highest dividend money pays, rather than just accumulating more stuff, avoiding that leaky bucket.
Right. We also explored tail events, how just a few outlier successes often drive the vast majority of results, whether in investing, business, or even creative pursuits. It makes you realize that it's okay for most things not to work out spectacularly.
Yeah, you don't need every joke to land, just a few killers. And distinguishing between being rich in the visible stuff and being truly wealthy, the hidden assets built through discipline and not spending.
Mm-hmm. And finally, that concept of the real price of investing. Seeing volatility and uncertainty not as fines to be avoided, but as the necessary admission fee you pay for the potential long-term rewards.
And wrapping up with the crucial need to define enough for ourselves, to avoid getting trapped on that never-ending hedonic treadmill.
So maybe a final thought for everyone listening. Take a moment to consider your own financial DNA, those ingrained beliefs and experiences from your past. How might they be shaping your money decisions right now, maybe unconsciously? And what could you gain by accepting that progress often looks more like slow compounding than overnight miracles? And perhaps most importantly, what does enough truly look like for you, not just in dollars, but in terms of control over your time and your life?
Lots to think about there. Thanks for watching this. See you in the next episode. Like, subscribe, and share.